Hey guys, are you planning to start investing? You are tired of the rat race and it seems that no matter how much your wage goes up, you are still struggling or it's just not enough. Don't make some rookie mistakes and just dive in. You have to do things step by step. You need to start with the first step, not the fifth. Okay, so I have your attention, I hope. Let's dive into this. The first thing you need to do is not open a brokerage account or choose some companies in which you invest. It's to set a goal. We are in different stages of our lives. We have different incomes, expenses, and different goals. So set that one up. Either if you want to invest for a down payment for a house, a car, your child's education, no matter the reason, you need one so you can build a plan around it. The second thing is determining your risk aversion or tolerance. This is a very important step because it may determine what you buy so you don't do stupid things like panic sell or FOMO buy. If you know for sure you can withstand a minus 70% drop in your tech stocks because the world is going bananas, and you can double down or dollar cost average like a crazy person in your semiconductor stocks or whatever, a riskier portfolio is for you, and that means your tolerance is high. But if you want a more steady approach, well, that won't work for you, and maybe a portfolio inclined to investing in ETFs and bonds will be the better approach. Now you know why you want to invest and your risk tolerance, and it's time to learn. Yeah, no investing for you yet, because if you don't learn at least the basics of stocks, mutual funds, ETFs, and how they work, including a very high overview of how the macroeconomic environment works, like importance of the Fed interest rate hikes and decisions, unemployment rate, real estate market index, commodities, oil and gas especially, you will just enter blindly and won't be able to understand why something is happening, why the market is going sideways, and if it's time to cut your losses or to withstand the storm. You know, it's a statistic that says 70%, 80% of investors lose money, and the reason is because they buy the top, panic sell in the bottom, and never learn from their mistakes. They just blame it on someone else because it's easier. I'm not saying that you need to have a PhD in economics, but some basic knowledge and giving it a few weeks at least to understand this space would make a significant difference. Okay, you should have a decent grasp of how things work right now. And the fourth step is to choose a broker. When choosing a broker is about preference, but the only thing I would stress is to choose a broker who will grant you the option to buy equity stocks, not contract for differences or options. You are an investor, so you want to own what you buy. Another thing would be related to what I mentioned earlier when we talked about risk tolerance. A good way to measure the level of confidence of a broker, at least for me, is from the onboarding process. If you just do 5 clicks and you need an email and that's all, I don't see it as a very trustworthy broker. But if they ask you for your risk tolerance, income, investment plan, goals, and so on and so forth, well, I trust those guys more, as they won't throw you into the lion's den. Good, we have that figured out. It's time to invest. And if you went through the earlier steps, you know what you want. Higher return with higher risk, lower return with lower risk. There will never be a middle ground. There will never be the option to go low risk, high return. At least don't get tricked by those who say the opposite. You can choose to invest in individual stocks, mutual funds, ETFs, or any other type of investment. The general rule says that diversification is key. But I think going forward, a well-balanced ETF portfolio, for example, will offer you that. Either going for an S&P ETF, a world ETF, or a more specific ETF like I like the semiconductor space, or a consumer staples ETF, a consumer discretionary ETF, and so on. Here's the tricky thing. Warren Buffett has an interesting thought. Why diversify in 20-30 companies when you found a good one where you can sink all your time and effort and money, of course, get to know that company like you're the CEO, but profit more than the CEO? It's a valid point that Warren Buffett has, but most people will never get the true grasp of a company and won't feel confident to do so, and they will probably panic sell at a point. We are close to the end. Now you need to keep investing. Build yourself a schedule around this. Keep tabs on your investments. Don't ignore them and leave them up to faith, but also don't obsess over them. Don't panic click every minute to see how your portfolio looks. Just read the news, analyze the main economic topics of the week, and live your life normally. Stress and obsession will bring your downfall, so you need to be constant and stick to your plan. Have it become like muscle memory and stay disciplined and educated. Remember, investing involves risk. No one will guarantee you profit, but you will get better and better at it. And always rely on yourself, not others. It's your money, not someone else's. Hope you liked the video. Don't forget to actually like the video and subscribe, and see you in another one.